Folks, President Trump is planning to absolutely flood the market in this new year of 2026. In today's video, we're going to break down exactly what you need to know and how you can use this to your advantage, because there's going to be a lot of people that this becomes a shock for that are going to be left behind. And then there's going to be a lot of people that were prepared for this that are going to benefit massively. We're going to break all this down for you with the timestamps down below. And the only thing I ask in return for all of the work that goes into making a video like this is that you hit that like button, and also don't forget to subscribe. Every time you do that, YouTube goes and pushes this video out to more folks, which helps us prepare more people for this year. And as always, if you are the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Okay, so we need to start with the first wave of this flood, and this is a big one. On December 18th, President Trump made a statement that should have every investor paying attention. He declared that we will have, and I quote, the largest tax refund season of all time. Now, Trump is known to exaggerate, of course, but this isn't just political rhetoric. Independent analysts and Treasury officials are confirming this with hard data. Treasury Secretary Scott Bessent said we're going to see gigantic refunds in the first quarter. He's projecting 100 to 150 billion more in refunds than last year. Some estimates go as high as 500 billion total flowing into American pockets and companies. Now, let me explain to you the mechanism behind this, because few people understand this and few people are even aware that this is a thing. When Trump signed the One Big Beautiful Bill Act on July 4th of this past year, it included massive tax cuts that were retroactive to the entire 2025 year. It was retroactive. But here's the thing, the IRS never adjusted the payroll withholding tables after the bill passed. What does that mean in plain English? Well, it means that every American worker has been overpaying their taxes all year. And so when the refunds come out, cha-ching. And a lot of people don't even know to expect this, because their taxes got cut retroactively for that entire year. And employers kept withholding at the old higher tax rates. So for a lot of people, they're going to get a much bigger refund than they were expecting. So when people do file their returns, well, the IRS has to give them all back that money in a massive lump sum. This isn't stimulus. This is people's money coming back to them, but it's going to have the same effect of stimulus. Now, if you're coming at this from the market perspective, here's where this gets really interesting. So if you go back to the COVID stimulus era, there were some clear parallels here. In March of 2020, the CARES Act handed out $1,200 per adult. December 20, another $600. March 2021, the American Rescue Plan added $1,400 per person. Well, the total COVID stimulus in that first round was about $814 billion. Well, what happened to tech stocks after that? Well, the most explosive rally in history. The NASDAQ surged 49% in 2020 alone, another 28% in 2021. That's 76% gains in the overall index in just 2 years. The FANG stocks, back when that was still the terminology, the acronym, well, they absolutely exploded. Apple was up 82%, Amazon up 79%, Tesla up 394%, and Nvidia up 87%. And here's the data that Wall Street doesn't want you to know, and you might not even know. Research shows that of the $814 billion distributed in that first round of COVID stimulus, well, $100 billion went directly into the stock market. $100 billion. And that's just directly. If you look indirect, it's probably way more. Now, this isn't a coincidence. There's a direct causal link here. So think about that, and then think about what's coming. We're looking at potentially $500 billion worth of refunds coming in the next few months. So there are 7 major provisions that you got to look out for that are going to create a massive refund wave. For starters, number 1, the standard deduction increased by $750 for singles, $1,500 for couples. Number 2, the child tax credit jumped by $200, now permanently set at $2,200. It was supposed to drop back to $1,000 in 2026 under the old law. Instead, it's going up. Number 3, the SALT cap, state and local deductions. This was raised to $30,000 for people earning less than $500,000. That's huge for anyone living in California, New York, New Jersey, or any high income tax state. It's also huge for people living in Texas, where there's high property taxes, no income taxes, but high property taxes, and their cap has just been raised. What you can actually write off in terms of state and local deductions off your federal returns, right? Number 4, senior 65 and older get a brand new $6,000 additional deduction. If you're married and both qualify, that's $12,000. A beautiful deduction there. Number 5, auto loan interest is now deductible up to $10,000 per year through 2028. This is designed to stimulate vehicle purchases. You got to buy American cars. Number 6, no tax on tips. Workers can now deduct up to $25,000 in tip income. And number 7, no tax on overtime. Up to $125,000 in overtime pay can be deducted, doubles for couples. Now remember, none of these provisions were reflected in paychecks this year. Employers still withheld all this money. So when folks go to to actually file their tax returns, what's going to happen? They're going to have a much bigger refund than expected. Okay, secondly, there's another thing that flew under the radar that a lot of people are missing, and that is the Trump account. The one big beautiful bill created something called Trump accounts. These are stock brokerage accounts for minors, people under 18, but here's what makes them unique. You see, if you're a U.S. citizen born between January 1st, 2025 and December 31st, 2028, you're eligible for a one-time $1,000 contribution from the U.S. government directly into your stock account. Parents can contribute up to $5,000 a year on top of that, and here's the kicker. The money has to be invested in funds that track the U.S. stock indexes like the S&P 500. According to the White House, if a Trump account is fully funded at $5,000 a year, a kid can end up with $1.9 million by the time they turn 28. And these Trump accounts are expected to start in 2026. Thirdly, let's talk about the $2,000 tariff dividend. So President Trump has been pushing for a $2,000 tariff dividend check for most Americans. And here's the logic. The Trump administration put tariffs on most foreign countries, as we know, and those tariffs are expected to bring around $200 billion in revenue. That is way more than the $30 to $40 billion in tariff revenue that the U.S. was collecting before. Now, in terms of the stimulus, National Economic Council Director Kevin Hassett said Trump is expected to formally present legislation to Congress. And there's even legislation already in play. Senator Josh Hawley's bill would send at least $600 per person, meaning a family of 4 could get $2,400. And if tariff revenues exceed projections, payments could increase. Now, this stimulus still needs congressional approval. There's also a Supreme Court challenge to tariffs themselves, but the intent here is clear. And there's about 1 billion workarounds that the administration can do to both make sure their tariffs are in place and also either use that money or print money to create these stimulus checks. Okay, the next flood, which is American state capitalism. Government coming in and buying up stocks and picking winners and throwing tons of money behind these winners. So as you know, in 2025, the US government started directly investing in private companies on the stock market. And a lot of people complain about this, but you could literally copy the trades that the government is making to help yourself come out ahead. In 2025, the government invested billions of dollars to buy about 10% of Intel. Why would they do that? Well, because the government wants to help Intel compete against China in semiconductor manufacturing. Another company that the US government invested into was MP Materials, a rare earth mining company. The government also let $700 million to Vulcan, another strategic minerals company. They took a golden share in US Steel, giving them controlling voting rights to determine what the company does. And they've changed policy on Bitcoin. Previously, when the government seized Bitcoin from criminals, they'd sell it off. Now they're holding it, building a Bitcoin reserve estimated at around 200,000 BTC. And the administration and the Treasury Secretary signaled and said actually very clearly that they're looking to do more of these private deals, which means more crazy rallitos to trade off of and more stocks to see outperformance once the government gets behind them, and certainly before the government gets behind them, because the rumor rally and then the confirmation rally and then the taking profit cycle is usually the cycle that plays out at first, and then long term you get the long-term value appreciation. Okay, and then final way that the White House and really policymakers are going to flood the market is through the Fed. There's going to be a massive amount of liquidity coming into the market, and every time you get this kind of massive liquidity, if you look at the last 100 years, well, eventually during that cycle, you get asset prices and inflation melting up. You have to understand that after years of high interest rates crushing certain parts of the market, the Fed has shifted very aggressively into cutting mode, and consensus is calling for 3 more cuts in 2026. I understand that the current Fed folks are trying to tease and say, no, we'll only do 1 cut. Well, again, that's just not what markets think. And whoever the Fed chair is that Trump appoints in May is going to push for more cuts. Trump has been openly critical about rates being too high forever, and he's been very specific. He thinks rates should be at 1%. If he even gets close to that 1%, you won't even believe what kind of melt up we're going to be headed for. Now, why does this matter for stocks? Well, lower rates reduce borrowing costs for companies, makes it cheaper to finance growth, makes acquisitions easier and more common. Lower rates make stocks more attractive compared to bonds when you can only get 3% from treasuries instead of 5% that you could have got for the last couple of years. Well, that growth stock starts looking a lot more appealing, especially if they can return 10 to 20% a year, as a lot of the AI stocks did in 2025, and lower rates mean higher valuations are justified. When you discount future cash flows at a lower rate, present values go up. That's just how the math works. So something that you might say is really overvalued in a high interest rate environment could be fairly valued or even undervalued in a much lower interest rate environment. And consider that we just came off of the highest, fastest rate hike in like 40 years, and that can make a big difference. Now let's talk about specifically where you're going to want to be looking, because let's be real, wealthy investors, smart money, they don't just randomly buy stocks. They identify where the economy is shifting and they position accordingly. So here's 6 areas to know. Sector 1, rare earth minerals. Now, this sector has been in the bear market for a bit, but there's a lot of opportunity here. Trump signed an executive order titled Immediate Measures to Increase American Mineral Production, and the goal of this executive order is for the U.S. to produce these minerals without relying on China. And we've already talked about specific areas where they've invested, like with MP Materials, but there's likely going to be a lot more this year, and a lot of overall industry support. So ETFs to consider: REMX, which gives exposure to rare earth and strategic metals. There's about 30 companies here. And then DMAT, which focuses on disruptive materials. There's about 50 holdings there. Now, Rare Earth Place took a big dip the last few months. They had a really nice Q2 and Q3, but by October, they had kind of peaked and then gone down as a whole. However, that's leaving a lot in good deal territory, and one of my favorite individual stocks for this rare earth segment is USAR, USA Rare Earths. This is a pure play domestic rare earth bet. USAR is building a full mine-to-magnet supply chain from scratch right in Texas. Their round top deposit contains heavy rare earths, which are very, very critical and harder to source than what a lot of the other domestic companies are doing. Okay, Sector 5, cybersecurity. As you know, AI usage is exploding, and people and businesses are pouring their secrets into ChatGPT, Claude, and Gemini. That means cybersecurity is more important than ever. And we're not even talking about the more intense cybersecurity requirements of platforms that institutions upload their entire systems into. President Trump signed an executive order to strengthen U.S. cybersecurity. The government is putting tax dollars towards cyber defense against foreign threats. A big ETF to consider in this space is CIBR, which is the first NASDAQ cybersecurity ETF. About 33 companies, heavy hitters in the space. In terms of my specific favorite 2 cybersecurity stocks that we've been talking about for literally years, well, CrowdStrike is one of them, CRWD. This is a cloud-native cybersecurity leader. Their Falcon platform uses AI to detect threats in real time across endpoints, cloud, and identity. But what is beautiful here is that this is a subscription model with 98% gross retention. That is beautiful and makes my mouth water. And then you've got Palo Alto Networks, PANW. This is a cybersecurity Swiss Army knife. Firewalls, cloud security, AI-powered threat detection, security operations, they do it all. Sector 4, energy. So every time you ask ChatGPT a question, you're firing off thousands of endpoints in a data center. Multiply that by every person and business and government institution that uses AI every single day, and oof, you're using a lot of energy. Now, the Trump administration is, of course, pursuing energy independence, moving back towards oil and fossil fuels for better or worse, and pushing heavily into nuclear energy. Eventually, you're going to have a change of administration, and you're going to see a push back out of fossil fuels. Nuclear energy is one of the easiest clean power sources you could possibly have. And this is going to be the #1 source of powering the future of AI. So if you want a long-term bet on energy, nuclear stocks are the way to go. We have a few specific stocks we like in this space, but in terms of an overall ETF, we really like NLR. NLR has a combination of uranium miners and nuclear utilities and other parts of the overall nuclear apparatus. And there's about 28 holdings there in that ETF. Okay, Sector 3, biotech. So during COVID, biotech companies over-ordered supplies, then they spent years destocking. Well, that's now ending. West Pharmaceutical said in late 2025 that destocking is largely behind us. So that means that biotech companies are going to start ordering again. ETFs to consider in this space, well, XBI, which is the Spider S&P Biotech Index, that's about 133 heavy hitter holdings, and then IBB, which is the iShares Biotechnology, about 250 large biotech companies. Okay, Sector 2, AI infrastructure. The biggest winners are going to keep winning. The companies that were more hype than actual execution aren't going to do much, and then the companies that were investing heavily in 2024 and 2025 to dominate AI in 2026 and beyond are going to start growing massively. Data centers, semiconductors, servers, cooling systems, energy providers for data centers, lots of opportunity. You have to understand that hyperscaler CapEx is approaching $600 billion in 2026. Goldman Sachs, the Sachs of Goldman, projected $1.15 trillion from 2025 to 2027. AI infrastructure spending is contributing more to GDP growth than all consumer spending combined. And Trump signed an executive order to make it easier to build data centers. So ideas, of course, you still have the top dog, NVIDIA, NVDA, obvious, but it's still the undisputed GPU king. Blackwell is ramping. Every hyperscaler is buying. Lots of opportunity still here. It's not going to be a 100% plus run, but I think it's going to outperform the market by quite a lot. Advanced Micro Devices, AMD, this is a runner-up to NVIDIA. They're getting a lot of the overflowing supply. In many cases, they're a more economical choice, and a lot of the orders don't take as long to fulfill. And they're so centrally located to the overall AI boom that it's actually a surprise that their valuation is as cheap as it is. I think there's a lot of upside there. Broadcom, AVGO, custom AI chips for Google, Meta, and others, plus networking infrastructure, diversified AI exposure. Marvel Technologies, MRVL, custom silicon, and data center connectivity. They're designing chips specifically for hyperscalers, a lot of upside there. Arista Networks, ANET, the networking backbone of AI data centers. When you're moving massive amounts of data between GPUs, you need Arista switches. Vertiv, VRT, data center cooling and power management. AI chips run hot. Someone has to cool them down. VRT is the player there. Equinix, EQIX, this is the largest data center REIT, global footprint, interconnection services, the landlord of the AI revolution. Now, if you're somebody that's looking at these stocks and you're like, yeah, but they actually already had really good 2025s and 2024s. Well, if you go back to my videos the last couple of years, many of these were stocks that we called out at much lower valuations. And even when we called them out back then, people said, yeah, these are too pricey. Well, you have to understand that a lot of these companies have grown substantially in terms of their revenues and earnings and their overall foothold on a massively growing technological revolution, right? So I understand that a lot of people will say, you know what, I like these stocks, but I want to wait on the sidelines. The best way to play these stocks are conservatively over time and ideally on dips. But you also can't expect these stocks to go down 80% to where they were a couple years ago. Sector 1, robotics. So China has built dark factories operated entirely by robots, no lights needed, and the US is basically playing catch up here, pouring billions into robotics, and that money is going to continue flowing this year, and that's going to lift a lot of tides. Morgan Stanley recently said we're getting closer to profitability with robotics than we think, and that impacts warehouses, factories, healthcare with surgical robots, even food service. ETFs to consider in the space, well, BOTZ for starters, that's robotics and AI, about 51 companies, including industrial robots and autonomous vehicles, and then Robo, ROBO, which is the global robotics and automation, about 77 key holdings there. Now, specific stocks to consider. Number 1, Tesla. This is a big play on the future of robots. Elon Musk has said Optimus, their humanoid robot, could be worth more than the entire EV business. A general purpose robot for warehouses, manufacturing, household tasks, elderly care. The total addressable market here seems impossible to calculate, but also it seems gargantuan. Tesla already has a massive advantage because, quite frankly, they have a massive team. They have a lot of talent. They have endless capital. It's easy for them to get even more capital. And while it is still speculative and the valuation of Tesla is high, it's hard to argue that Tesla isn't going to be one of the big players in this. Always remember the golden rule. He who has the gold makes the rules. Tesla is the one with the gold. Tesla's going to be the one to attract talent and technology and invest endless amounts of money into distributing whatever that is. Is it expensive? Yes. Should you wait for a dip? Yes. But is this something that's going to go higher the next few years? I would argue very much so, yes. In terms of healthcare, I like Intuitive Surgical, ISRG. In terms of dark warehouse plays, automated factories, I like Symbotic, SYM. In terms of collaborative robots or cobots, I like Teradyne, TER. And in terms of the eyes, the actual seeing mechanism of robots, machine vision systems, I like Cognex, CGNX. So these are the very specific stocks and sectors that you should consider as we go into 2026. Anyways, folks, bigger picture, and we've been talking about this for a very long time, but bigger picture, in order to both protect yourself and come out ahead this year, well, you're going to have to position yourself to be the person that the system, the entire economic system that we have here in the US of A, is designed to benefit. And that is the asset owners. And that's what we're fired up to give you here on this channel and in our Discord. So anyways, what are your favorite stocks for 2026? What are your predictions for 2026? And let us know how you're positioning yourself in the comment section down below. We love hearing from you. And that caps off today's video. Happy New Year. I hope you had a great holiday season with your family, but now it's time to get to work. And of course, quick plug, if you want to get 26% off our Discord membership, well, I'll put the link to get that down below. Have a good one, folks. We'll see you next time.